Don't know where to start. This is very disappointing, very frustrating. Dow today again down 400 points. So it's been down almost every day for the past 3 weeks. FTN down 14% today. So this is a stock I bought at 7.4. Trading right now at 4.44. So very disappointing. And of course, it declared that it's not going to be paying dividends on Class A shares. So that's why it took such a big hit. So right now I hold a stock that I paid a bit too much and does not pay me any dividends. So this was a bad decision. But not selling, we'll have to keep. We'll have to wait a little bit longer until it recovers. But I mean, everything is down. Everything looks very attractive. But I'm definitely not going to buy right now because it looks like it's going to continue. It looks like it's going to drop some more. I want to see what's going to happen first. But definitely regret even more not selling my stocks on that Monday when the Dow was up 400 points, because not only would I have made a profit of 1,500 Canadian, but I would have had my cash available to buy more stuff. And also I wouldn't be down. I wouldn't have losses on that cash. So I'm actually not only did I miss out on 1,500, but I incurred losses by holding these stocks. I didn't sell them, but I'm at a loss position because all of these stocks went below my initial purchase price. So definitely regret not selling that on that Monday. Square is looking interesting. This is a stock I wanted to buy at 50. Today reached 53.76. So we'll definitely keep an eye out. Walmart is looking interesting as well. Trading in the 80s today. Lowest today was 86.14. So this is a stock definitely I'd be interested in buying at around 80, but it might even drop even lower. Now Suncor, I remember Suncor. This is a stock I was going to buy, or I bought in 2009 at 30 and I sold it at 35. Now imagine if I had kept it all this time since 2009. So for 10 years, imagine if I had kept it for 10 years and the stock 10 years later is only trading at 37. I would definitely be disappointed. I would feel like it was a waste of time. Yes, it did. Yes, it was paying dividends, but I mean 4% dividends compounded with inflation, it's not a big deal, I find. If I look in the past 5 years, if I had bought it, let's say at 35, sold it at 39, here it was trading at 42, but I probably would have sold it at 39 and then waited for it to come back down, would have bought it back at, let's say, 36, and then here I'd be stuck a bit because it never, well, actually went to 39. So see, from 36, I would have sold it at 39 again. And then it drops again to 34. I would have definitely bought it back. And then not sure if I would have sold it at 38. Probably would have kept it a bit longer. Then it never reached the price I wanted to sell it at. So I would be forced to hold it a bit longer than expected. But at least I'd be collecting dividends in this period here. But then I would have had a chance to sell it here at 39, for example. And then here probably I wouldn't have a chance to buy back in as it continues to go up but in that case I'd be moving on and looking for something else to buy. And now today, look at it, 37. So that's why sometimes I don't like the long-term investment or holding something forever, because 15 years could be just wasted. I mean, ExxonMobil, man, I bought this at 75, had a chance to sell it at 81, didn't. Now it's trading at 68. At least it pays 4% dividends while I wait for this thing to recover. Cano EIT Income Fund is looking good as well. This pays 10% dividends. Now I'd have to make sure if it's going to be able to pay it out. Now this is a mutual fund that invests in 25 stocks, I believe, and they generate a monthly distribution of 10 cents. It's similar to Quadravest, I guess, because they sell covered calls against their holdings, but would need to find out first if they're consistent on paying their dividends. But this could be interesting to hold in this recession, because if it's able to pay the dividends, then it's a great dividend rate at 10%. Capital gain wise, I mean, it's been always trading at around 11. Like in the past 5 years, you could see 11.9, 12, 10. So it trades between 10 and 12. So there isn't much capital gain potential, but it's great for dividends, 10% per year. American Express is getting closer to a price I'd be more interested at. In the 80s, I definitely want to buy some American Express. It's a stock on Warren Buffett's list. See, 52-week range is 87 to 114. So that's great, but I'd wait for it to drop below 90. JP Morgan Chase is looking good as well. A Warren Buffett purchase. I bought this at 103. So 96, it's looking even better. Now this is an ETF that tracks the price of oil. I was thinking of buying it because, as you can see, oil has dropped very hard. I was thinking of buying 100 shares and actually selling covered calls, but I don't know. I'm not too sure because not sure what's gonna happen with oil. But I think it's pretty low. I mean, the lowest it has been for a very long time was around 30 or 35. So right now it's trading at 46. I think in 2009 it was trading at $30. So would be fair to say that this is the lowest point for oil, but you never know, right? So, but the reason I was thinking of buying 100 shares of this because it's not going to cost me much. It's going to cost me less than $1,000. But the option price looks good. Let's say I buy 100 shares, and if I sell the covered calls of January 18 at a $10 strike price, for example, I'd be able to sell it at 41 cents. So 41 cents times 100 minus $11 fees, that's $30 on a $980 investment, for example. That's 3% per month times 12, that's 36% per year if I'm able to do it every month. But I'm not too sure about the price itself, because if I buy it at this price and then next month it's trading at $8, I'm not going to be able to sell covered calls again. So just a thought that came to mind, but not sure if I'm going to execute it. I bought Apple at 160. So yeah, with everything going down, everything looks good right now. So many choices. But of course, we don't know what the lowest point is. If it might continue to go lower. So I'm going to wait a bit since I don't have that much liquidity. I've already bought a bunch of stuff like 3 weeks ago, so can't buy anymore. Costco broke the 200s, trading at 197. Actually, today the lowest was 193. So imagine this stock I bought at 150, sold it at around 170. Now imagine if I had kept it all this time. Where's the 150? It's been more than a year. Okay, so I probably bought it around. So probably bought it around here. So November 2016. I'm pretty sure I bought it in 2017. Anyways, so imagine holding a stock for all this time and then it just comes back to the exact same purchase price. It'd be very frustrating. Kellogg's looks good as well. Maybe not my first choice right now, but so many stocks looking good. MasterCard reaching my initial purchase price. Had a chance to sell it at 210. Now look at this, back to where I bought it at. Amazon, same thing. I don't even want to look at it. Google, I had an order on Google today at $995, and I think the lowest was $996. Yeah, so the lowest today was $996.37. I had a buy order at $995, so it didn't go through, of course, but very close. And it was not too worried because I think general market is going to continue to drop. CIBC is looking good as well, up to 5% dividends right now. It's at a 52-week low. 52-week high was 125. It's a bank stock, paying decent dividends. So really, lots of good choices right now. Just not too sure if it's the lowest point. Very disappointed at how much I've lost in 2 weeks. But the only thing that keeps me patient is the fact that I've got a lot of dividend stocks. And if I look at my RSP, I've got Bank of Nova Scotia, which is a dividend stock. General Mills, dividend stocks. Facebook is not a dividend stock. AltaGas is a dividend stock, even though it dropped a bit. Honda Motor is a dividend stock. DFN is a dividend stock. Vodafone is also a dividend stock, but it's twice a year only. Ford is a dividend stock. Alibaba is not. DF.to is not. And FTN just recently decided not to be a dividend stock. So it's good that I've got probably 80% of my holdings here that pay out dividends. In my TFSA, I've got Ford and AT&T that pay dividends. Dividends that I've recently received, got some from Vermilion Energy, from DFN.to, and Ford as well, Ford. And in my Investor's Edge account, I got some Kraft Heinz and some AltaGas as well. So I'm glad I've got a bunch of stocks that pay dividends, but definitely disappointed that my overall portfolio is at a down. I mean, it looks like my dream of reaching, or my goal of reaching $500,000 in my portfolio in 7 years is not going to happen. Looks like I'll just have to be content at making more than a savings account at the bank. So yeah, for the moment, I'm not going to buy anything. Maybe just Google, but anything else I'm going to wait in case it drops some more. And if it doesn't drop some more and it decides to go back up, well, I've got a bunch of other stocks that I'm waiting for them to recover, so I won't feel the need that I missed out. Sun Life is looking good as well. Yeah, definitely want to buy some Sun Life, and let's look at Manulife as well. Here you go, MFC.to. So yeah, this is a good stock, pays 5% dividends, got good potential capital gain. I could probably buy 100 of Manulife, sell some covered calls against it. So this probably makes sense. I could probably buy 100 shares of Manulife. It's going to cost me $19.45, and I'm expecting it to drop or maybe stay steady for a while. So while I'm waiting for the stock to recover, I can potentially get 5% dividends per year, and I can try to sell covered calls every month. So for the first month, I'll be able to sell covered call, let's say at around $20, and I'll collect, let's say 41 cents minus 11, so $30 divided by a 1942 investment. So 1.5% per month, or at least for the first month, times 12, that would be around 18% per year. So if I'm able to sell covered calls every month on this stock while I wait for it to recover, I could potentially make an extra 20% over the dividend yield that it's paying. So I could probably make like 25% in a year if I hold on to it. Actually, let's see if I sell the covered call for a year. Since I expect that for the next year it might be horizontal and drop, I could probably sell January 17, 2020 calls, let's say at a strike price of 20 or even 21. Let's say 20. Sell it at around $1.60, let's say. So it's $160 minus $11 fees divided by the 1945 investment. So that's about 7% per year. So I think I'd rather sell the monthly covered call, even though I risk not being able to sell it every month. So yeah, that could be a potential trade just because of the 5% dividends and the possibility to sell covered calls every month. Because right now, bank stocks and insurance companies are not going to go anywhere. Sun Life is good too, but I'm not able to buy 100 shares of it. So I'd only be stuck with the 4% dividends. So let's see what on my watch list went up today in this ridiculous. Bombardier went up almost 5%. Thank you. Makes no sense. General Mills went up. Activision, WestJet, some gold stocks, Dollarama, Johnson & Johnson, Vodafone. Even Facebook went up a little bit. Actually, I've got Bombardier shares. I've got Bombardier options that expire tomorrow. So I actually have the potential to sell covered calls again. So that's good actually. So the first month I sold covered calls, it was around 4.5% return. I think it's fair to look at the price today. It won't change much from tomorrow unless it drops hard tomorrow. If it goes up tomorrow, then that's perfect. The covered calls the call premiums will be higher. So let's say I sell the January 18 call at a $2 strike price. So January 18, expiring January 18, $2 strike price. I could sell it for 20 cents, let's say, times 500 shares. That's $100 minus $15 fees divided by a $1,000 investment. So that's going to be an 8.5% return in the next month. If I go for the 225 strike price, I could sell it for 13, let's say. So 13 times 500 shares minus 11 divided by a $1,000 investment. So that's 5.4%. So first month I would have made 4.5. I made 4.5 already. And if Bombardier trades at the same price tomorrow, I can probably sell more covered calls and could get a return of 5.4% if I choose the 2.25 strike price. If I choose a $2 strike price, I can get an 8.5% return. So the difference between both strike prices is if the stock in the next month, so between tomorrow and January 18, 2019, if the stock goes past $2 and the premium that I sold, then my shares will most likely get sold automatically. So I bought them at $2, they'll get sold at $2. But at least I made 4.5% the first month and I made 8.5% the second month. So I made 13% return in about 2 months. So if I don't want my shares to get called away, I could probably take a higher strike price if I think that if I think the stock won't surpass the strike price plus the premium, so 225 plus 13 cents. If I think that in the next month Bombardier doesn't surpass $2.35, then I could take this strike price and I'll make a 5.4% return and I'll still keep the shares and just keep making 4 or 5% return every month this way. And I could keep doing it until the stock reaches probably $3 or $4 if I want to. And then at that time, if I'm comfortable to sell it at $4, I can sell it at $4. So it's a great way to keep a stock forever without missing out on profits. But I mean, if the market continues to crash, I'm sure Bombardier is going to join all the other stocks and it's going to drop as well. So we'll see what happens tomorrow. I'll most likely choose between $2 and 225 cents. I'll probably sell the $2 strike price just to get a higher return, because I don't think Bombardier is gonna surpass $2.20 between now and January 18, 2019. I also got Barclays that will expire tomorrow. So this is a stock I bought at $8 and I sold the strike price at $8. So tomorrow if I sell the options that expire January 18 and if I choose the same strike price, they're worth about, let's say, 25 cents. I think I have 200 shares. So yeah, 25 cents times 200 shares minus $12 fees divided by a $1,600 investment. So that's about a 2.3% return for the month. And for the year, it'll be 28% per year if I'm able to do it every month. But I got to take it 1 month at a time. If I choose a $7 strike price, there's a risk because I'd be taking a strike price lower than the current market price. So there's a good chance that my shares would get called away at $7, but I bought it at $8. So I would lose $1 if my shares get called away. So in this scenario, I cannot choose a $7 strike price. I'd have to choose at least an $8 strike price. But of course, it'll depend on at what price Barclays will trade at tomorrow. Now I want to look at what is considered a crash. I mean, why aren't we considering this a crash? I'm going to try to predict what the lowest point is, just for fun, just to see what's going to happen. Now we can see in 2008 or 2009, so this is a crash here, and you can see this line here. Look how vertical it is. This is the biggest moment in the crash. Even this one here, this is the lowest point here, but it wasn't even as steep as this one. This was a faster drop. And if we zoom in, this occurred on September 22nd, 2008 to October 6, 2008. So this is a 2-week period. So this is 1 week and this is the second week. So in 2 weeks, you could see this is where the fastest drop occurred. And you can see that the Dow Jones went from 11,143 to 8,451. So in 2 weeks, the market dropped 25%. The Dow Jones dropped 25% in 2 weeks. This is the hardest drop in the 2008 crash. And then here you could see that in 4 weeks, it went from 8,200 to 6,600, and that's the lowest point here is 6,600 for the Dow Jones. So from 8,200 to 6,600, let's see how much is that. So that's another 20% in 4 weeks. So here you've got 25% in 2 weeks, but over here you have 25%. So here you have 25% in 2 weeks, but here you have 20% in 4 weeks. So it's a slower drop, but still a big amount, 20% for the Dow Jones. Right now we're dropping like 1 or 2% per day, and we're panicking. So this is 20%. This is 25% in 2 weeks and 20% in 4 weeks. So let's take the 25% divided by 10 business days, because a week is 5 business days. So that's a 2.5% drop every day. Isn't that what we're going through right now? Aren't we dropping like 1 to 2% every day, and we've been doing it day after day? This has been going on for 2 weeks, and this was called a crash. This year was going on for 4 weeks, and it was also called a crash. Well, all this is a crash. See, the crash was basically here. So stocks actually dropped from September 15, 2008 to March. So it took about 3 months in 2009 and then 3 months in 2008. It had a point where it was horizontal. So it took about 6 months. So the crash took about 6 months. It had 2 weeks where it dropped really hard, and then another 4 weeks where it dropped relatively hard. And then after that, it's just been upwards. If we look at the 20% here in 4 weeks, so 5 business days a week, so 20 business days, so it's about 20 divided by 20, so it's about 1% a day. So in the 2008 crash, we've had 2 periods where the market dropped really hard. The first period, it dropped 2% per day for 2 weeks, and in the second period, it dropped 1% a day for 4 weeks. And the whole crash period took about 6 months. And this occurred, of course, because loans were given out to anyone. People were getting loans that they weren't able to pay. And then when And then when the market realized that people had loans that were greater than the values of their homes, the market crashed. So it was a big deal. It was a big reason. But now, what's the reason today? I mean, yes, student loan is high. Interest rate is increasing. So interest rate is increasing. So people that already have loans, it's going to make their payment even higher. So might make it harder for them to repay their payment. So could that cause a similar crash to 2009? I don't think it's as bad as 2008 and 2009. So I don't expect the crash to be as big. Student loan could be a good reason. I mean, it is at its highest. I mean, if people can't pay their loans, they could just probably declare bankruptcies. It's going to affect the banks, the lenders who won't be getting their money back. Is it because of trade wars with China? I mean, is that going to really affect companies that much? I mean, corporate earnings are still very high. Each company individually is still doing very great. So what is causing this crash? I mean, these are the three reasons that I can think of: interest rate, student loans, trade war. And I still don't think it would cause a bigger crash than 2008 and 2009. Also, at the same time, you could see that in 2017, look how steep it is. Look how vertical this increase is. Here you have two dips, as you can see, and here we've already had a dip and then it went back up. So this could actually just be a correction to the increase here in 2017. And if you look at the Dow Jones here, September 2017 to January 22nd. So in about 4 months, the Dow Jones went from 21,797 to 26,616. So a 22% increase in the Dow Jones in only 4 months. That's pretty high. I mean, if you can make 22% per year, that's amazing. The general market went up 22% in 4 months in 2017. So this here could just be a correction to this increase, because it's a pretty fast increase. So how low could this go? It's either going to go as low as this just to fix the rapid increase that occurred, maybe an undeserving increase that occurred in 2017. Maybe it's going to go as low as the resistance point here. That would be pretty low though, 15,000, 16,000. So right now it's trading at 22,000. If it goes to 16,000, so that's about a 28% decrease. Could be a lot. I mean, if you look at 2009, if we compare probably, I mean, from here to here is normal. I wouldn't consider this a crash. Probably start from here. So if we start from here, so from 11,700 to 6,600, so we had about a 44% drop in the market in 2008, 2009, in about 6 to 8 months. 44% drop. That was 2008, 2009 general market. Went from 11,000 to 6,000. Now, would the market drop another 44% if it crashes? Personally, I don't think it deserves to crash the same way as it crashed in 2008. I don't think there are reasons to justify the same amount of crash or the same intensity of crash. So worst case scenario, I'd probably give it an extra 30%, and I would give it probably at this starting point here. So probably at 16,000. So 16,000 would be around here. So yeah, so worst case scenario, I think the market, if it does crash, the lowest it'll reach will be 16,000. That's just my opinion based on this analysis I just did in front of you. Just because I don't think there aren't strong enough reasons compared to 2008. And 2008 it crashed 44%. So let's say worst case scenario, I'll give it a 30% decrease starting from where we are right now, not even starting from here, starting from here. Worst case scenario, give it an extra 30%, which would bring us around here, 16,000. So it could either be a slight correction just to fix the rapid increase in 2017. So it could probably stop around here. You could probably stop at around 21,000. But if it's a crash, I would give it probably until 16,000. I would say it would reach around here. Now, if you look at 2008, when it crashed all the way to 6,000, when was it last trading at 6,000? So you can see it was trading at 6,000 in 2001. So it corrected basically 8 years or 7 years. 8 years completely wasted. If you were holding long term in this period, you've 8 years completely wasted. Yeah, so I think if I'm gonna buy more stocks right now, I'd probably wait until either it reaches 16,000, then I'm gonna start buying, or somewhere close to that, or maybe even somewhere in the middle, just to make sure I don't miss out. And if I miss out here, it's not a big deal because I've already bought a bunch of stocks. So yeah, in my opinion, I think the lowest point will be 16,000, and it'd be fun to see what happens. 16,000 for the Dow Jones, so an extra 30% starting from this point. And I think that's worst case scenario. And if we look at this decrease here, starting from here, so in 3 weeks, the market went from the Dow Jones went from 25,500 to 22,800. So it dropped 11% in 3 weeks, while in 2008 it dropped 25% in 2 weeks and then 20% in 4 weeks. So this is probably similar to the 20% in 4 weeks. So this is similar to this drop over here. Now that doesn't mean anything. It doesn't mean that it's the lowest point. It's not going to drop anymore. But what I'm saying is that the way it's dropping is similar to a crash. It's similar to last crash. It's similar to the last crash. We've had a 20%, 25% in 2 weeks and a 20% in 4 weeks. So I don't know why people are still wondering if we're going to crash or not. Why can't we consider this a crash? And look at the volume. Look how much volume is being traded right now. Same volume in 2008. So much volume. So there was volume going up and there's volume going down. So maybe when the volume dies down, that's probably when the lowest point is going to come. So here you could see, actually doesn't help much, but I'm sure volume has something to do with it. I don't know. I have a feeling it's a correction. I don't think we're going to crash all the way down to 16,000. But if we do crash, I think the lowest point is going to be 16,000 because I don't think it deserves more than an extra 30% drop. Now that's going to be just for the Dow Jones, for the general market. How is it going to affect each individual stock? I'm going to take a safe Canadian bank stock like CIBC. Let's look at this. Let's look at 2 years, 5 years. So in 2009, the lowest it reached was $37. Wow. I don't think it's going to reach $37 even if it crashes. So let's say it crashes the same way. Let's say it reaches back to this point here, which was around $84. I think that's fair, which represents about a 19% or 20% decrease from this point. I mean, if CIBC drops to $84, I think that's not a big deal. Won't take long for it to recover. It would definitely be a good purchase price at 84. I'm sure dividend yield will be higher as well. So it'll be a 20% decrease for CIBC starting from this price. Now hopefully it doesn't drop all the way down to 2009 numbers. Now it doesn't have to drop all the way down to 2000 numbers. Basically the crash should be compared to, we should look at it as a percentage. So if in 2008 market dropped 40% from its highs based on a certain reason, well, reasons today aren't as strong as 2008 and 2009, so we shouldn't give it the same percentage of drop. We should give it something lower. So based on a lower percentage, I'd probably say $84 or even $80 for CIBC, for example, would be the lowest point. All right, so even if stock market looks crazy right now, if you can open an account with Questrade to trade on the stock market, use my referral code in the description below the video to get between $25 and $250 back. If you have any questions, leave them in the comments below. If you like my videos, please like them, share it with your friends, and subscribe to the channel by simply clicking the watermark on the video. Very easy. And please support the channel by checking out the links in the description below the video. Thanks for watching.